Well, just a week into February, and love is certainly in the air as investors continue to pour money into their investments, prompting a roughly 3% lift for the S&P. But the big question is whether or not the love will be reciprocated by these companies, or is this just another little run-up from strong earnings reports? That, on top of the need-to-know macroeconomics and 7 dividend stocks, is what I have in store for you today. So with that, investors, are you ready? So where exactly do we begin? Well, I don't think I'm going to deliver any mind-blowing news here when I say that earnings season has been quite well. It's been one heck of a season, actually. I mean to say that a lot of companies reported blew away analysts' expectations, and that's just an understatement, which has all given way to bullish behavior and plenty of market momentum. Now, usually I'm the guy here on YouTube saying be cautiously optimistic, especially during earnings season when emotions are running higher, and of course investors are doing their thing investing. But to be honest with you, right now, where we stand, I actually am rather bullish myself for 2024. Why? Well, it all comes down to the Federal Reserve's outlook. Of course, as the last FOMC meeting, the Federal Reserve came out and held rates steady, but we could surely expect an eventual reversal in interest rates, which would send us well on our merry way into a bull market.
Are you committed to getting all the way to 2.0 before you cut the rates?
No, that's not what we say at all. No. We're committed to returning inflation to 2% over time. I've said that we wouldn't wait to get to 2% to cut rates.
Now, I'm going to go ahead and share some of my concerns outright with you. Global wars are not great for all of us investors, and moreover, the presidential election could certainly sprinkle in some uncertainty for us as policy changes begin to come our way, potentially depending on who's in the White House. But what does that really do for any of us? For long-term investors, nothing. So where do I think we should be focusing right now? Simply on high-quality stocks that are trading at fair or undervalued share prices. And while many companies are trading at some higher highs right now, there are 7 dividend stocks that I think are worth your attention right now. And before I cover them, I do want you to know that none of them are going to be mind-blowing new ideas. As a matter of fact, the first 2 are ones that I've recently been touting, invested in personally, and still believe they are rock-solid picks. But the reality is, at any given time, there aren't really a multitude of quality companies out there, so I think we should all remain focused on the quality rather than loading up on quantity. With that, the first stock here, Pepsi, ticker symbol PEP, which really doesn't need some big introduction. We're talking about a beverage behemoth that doubles as a salty snack king. Now, the stock fell really due to higher interest rates, but more so from investors being spooked away because of the negative impact on weight loss drugs manufactured by Pepsi, leading to its current share price of around $171 per share. That's down from nearly $200 per share back in May. Zoom out, we see over 181% worth of appreciation, and that all matters because if a company doesn't take any risks at all, well, they don't really grow. So I can applaud the weight loss direction that Pepsi was heading in. However, the manufacture of Gatorade, Quaker Oats, Cheetos, Doritos, and Tropicana, will it really disappear? Well, I certainly hope not. And we do have hedge funds that are rather optimistic here after loading up on 3.7 million shares last quarter, along with analysts who are rating the stock a buy with 7% worth of upside, coming up to $185 per share for Pepsi. Now, as dividend investors, we're all going to enjoy this 2.95% dividend yield that's been growing by roughly 11% year over year for the last 20 years while maintaining a nearly 60-year dividend streak. Next up, one of my all-time favorite top picks, we have a defense contractor that has just been unstoppable, Lockheed Martin, ticker symbol LMT, which remains one of the safest names in the industry solely from its clientele. I mean, good old Uncle Sam always bolstering up our military. As recently as earlier this week, a $150 million deal was struck. But also noteworthy, with global wars and just a potential swap in the White House, Lockheed is actually perfectly set for a comeback, which is why I like it down year to date here by $430 a share, PE ratio at 15.5. And as you can see, it slid in October but spiked back up at the onset of the Middle East tensions, and zooming out almost 260% worth of share price appreciation, to which I would only imagine it would continue. Likewise with analysts forecasting forecasting nearly 11% worth of upside, coming up to $447.10 per share. Of course, the dividend then is the cherry on top here, coming in at a 2.93% dividend yield. That's been ongoing on a dividend streak for 31 years, and growth year over year for the last 20 years, on average here by 16%. Now, investors, before I go ahead and spin us off in a different direction for our third dividend stock, if you're not already subscribed, listen up. I want you to go ahead and subscribe right now and join me on this journey. You'll never miss a dividend stock idea. You'll be a part of a financial freedom journey, and most importantly here, you owe you to take massive action on ensuring this is your year. Now, if this content is what you're enjoying, let me know by tapping on that thumbs up button, and I'll just keep tailoring this content to you. With that, we're going to go ahead and get back to it with Honeywell, ticker symbol HON, which is in the business of providing industry-specific solutions, including aerospace and automotive products, as well as services for control technologies for buildings and homes and performance materials across all industry verticals. Right now, it is down on the year largely from supply and demand and interest rates, trading right now at $194 per share. That's getting closer to a nice buy-in price. After all, big picture here, 165% worth of appreciation over the last decade. On top of analysts who are forecasting, check this out, nearly 20% worth of upside, coming up to $230.78 per share. Now, that's all nice, but you also get a dividend here, a 2.33% yield for the last 31 years of a streak. Now, we're averaging about 9% of year-over-year growth over the last 20 years. Now, I want to go ahead and play it a tad safer with all of you here with some healthcare companies like Amgen, ticker symbol AMGN. Recently, it has come back onto my radar after obesity drugs really took center stage and spooked a lot of investors away from Amgen, but we are talking about a world-leading biotech here. Anyhow, it slid by about 7% just on the week. Zooming out, I want you to recognize the sheer leadership of this company, almost 220% worth of appreciation, which goes to show you that it pays to be invested in healthcare companies. Now, you'll enjoy a nice dividend coming in at a 3.04% dividend yield, while on top of that, 11 years worth of a dividend streak, and all while growing by 18% year over year for the last 20 years. Now, really looking for promising upside here. Analysts are forecasting a $323.83 share price. That's nearly 10% worth of upside. Now, another global pharmaceutical company that I do favor and makes the list today, we're talking Bristol Myers Squibb, ticker symbol BMY, which is a company that I mentioned not too long ago on the channel, but recently it received a lot of downgrades, which spooked away a lot of shareholders. Can totally get that, but it also just received FDA approval for a lung cancer treatment, which is great news. Now, the stock itself slipped year to date here under $50 per share. Zooming out, we're going to see, just like Amgen, some growth, 24% worth of it over the last decade, current PE ratio at 12.8. Not to mention, very promising signals from insiders like the CEO who bought more shares back in December, hedge funds who have been scoring more shares here, over 2.2 million as of last quarter, and analysts who forecast nearly 20% worth of upside, coming up to $58 per share. And until then, you will reap the dividend benefits here with Bristol Myers Squibb coming in at a dividend yield of 4.93%, maintained a 53-year dividend streak, and has grown year over year by 4% over the last 20 years. But just before we pop out of the healthcare sector, I want to go ahead and direct your attention to the notorious United Health, ticker symbol UNH, which is arguably the largest healthcare coverage provider in the industry. Never truly discounted, but always worth a long-term buy and hold. At least in my opinion, we can see over 756% worth of appreciation over the last decade. So take advantage of it as it slides here. It is currently trading for $519 per share. The PE ratio rather lower here for this company at 21.4. Now, analysts are forecasting almost 15% worth of upside, coming up to $596.71 per share, all while hedge funds have certainly been scoring thousands of shares last quarter. But with United Health, the biggest benefit here is a stable, growing dividend, coming in with a lower yield at just 1.45%, yet with a 31-year streak, and get this, on average 41% worth of growth year over year over the last 20 years. Next up, we're going to jump right out of healthcare and into a agricultural play with Deere. John Deere, that is, ticker symbol DE, which shares a very similar story to United Health in terms of share price movement. Now, you do need to know that it certainly struggled in a high interest rate environment, but there's always a new season for crops and the company supplying the equipment to farm. So when John Deere begins to slide, like right now, it's trading for $385 per share, PE ratio at 11.2, yet experienced over 435% worth of appreciation over the last decade, this company has my attention. Now, analysts Analysts also foresee growth coming up to $420.33 per share. That's about 9% worth of appreciation, while plenty of hedge funds have been loading right on up with John Deere last quarter. But the long-term investor will benefit yet again here with this dividend only at 1.52%, yet with 13% year-over-year growth there with that dividend and a 30-year dividend streak. Now, investors, your thoughts on these dividend stocks matter and are definitely welcome, so go ahead and let me know in the comments down below. Discover more insights right here, but before you click away, just make sure you're subscribed to never miss a dividend stock idea.